Hello, YouTube. This weekend, we're going to talk about what you need to do this weekend and what you want to be aware of because 2008 and 2022 are still on track. They are still repeating, and we're going to pick up where we left off last week because we were talking about a 15% rally in about 10 weeks. We're already about 12% there, which means that's about 80%. And if we're almost about 80% there, what we really want to know is, are there some signs in history which tell us that we need to be mindful of where we could go from here? And the answer is yes. I say that because we're now into greed. And the last few times we fell into greed, that is where the top was formed, the short term top. We've been comparing ourselves to March. We went from 18 all the way up to 62. And then we went all the way back down to 3, a lower low. Where did we start? 18. Where are we now? 61. It's almost like history is repeating itself. And here we have a head and shoulders pattern. If we cannot get back above roughly 62. What we're going to circle back to a little bit later in the show is also the history of the psychology. And we got an update on SPY, Bitcoin, and ARK. There's a lot for us to go through, so we're going to jump straight in. As always, we would really appreciate if you could smash a thumbs up and drop us a comment and consider subscribing to the channel if you're enjoying the content. So we've talked about 2008 and 2022 for quite a bit now. And what I want to focus on here is actually going to be the green line. So this green line pretty much signifies that once we start forming higher highs, until that pattern breaks, that is our monster dead cat bounce, bear market bounce, or relief rally. So in this period right here, we form every single week, we form high, higher high, higher high, higher high, higher high for about 10 weeks in a row. What have we done so far? Well, we got about 3 here. We got 1, 2, 3. And by closing at the high of the week, it is very likely we're going to form another higher high next week. Why is this important? Well, it's important because I believe we're about right here where we do form a higher high, but then we flush to close the week out red and reverse a large chunk of the move. Where are we right now for our low? 373.11. And what do we know? Well, we also know that our yearly chart 373.88 is going to be our 2020 close. So when we look here back to 2020, 373.88 is going to be where we closed out in 2020. That would be a natural area for us to come back down to before confirming we're going to continue our dead cat bounce. So that's really what I want to go through this weekend. It's not all that complicated. And now that we understand where we are coming from versus where we're likely going to go, let's jump in and see exactly what else the charts are telling us. So we're going to remove all these lines, and there we go. Got them all back. We're now going to close this out, and we're just going to go through and provide a little bit of technicals and then, a little bit of fundamentals. Then we're going to come back and look at the chart. So after this week, Mike Wilson's been pretty good. He called the risk-on rally. Markets often need the engraved invitation from a higher power to tell them what's going on. For bond markets, it's the Fed. And for stocks, it's company management teams. What do we hear from company management teams this week? Well, Apple pre-announced and was able to come in and beat it. Microsoft guided down, Google guided down, Amazon guided down, Tesla did okay, Meta guided down. So when we look here to a 1-week performance, the only theme that is not green is big tech. So that is the higher power or the company management teams telling us that tomorrow is going to not be as rosy as today. It's going to be worse tomorrow than it is today. And the other reason why this is important is because the Fed acts for the bond market. And what we just reviewed is that we're due for a move lower this week. So now that we have the bulk of earnings out of the way with 15 trillion last week, and net, the market has breadth, it has depth, it wants to go higher. We got 6 trillion reporting this week. There are some notable names, but the focus is really going to be going to the Fed. So we got some names like AMD, names like, I don't know, like PayPal, Coinbase. There's not really all that many here that really are going to be significant for me, but it's still about 6 trillion, so that's notable. More importantly, we have economic data in focus, notably the FOMC on Wednesday at 2 p.m. We're going to get the rate decision, the statement, and the press conference. We also have CPI coming in from Europe on Monday, expecting 10.2%. That's pretty high. That's a higher high versus the previous report as well. We also have a payroll Friday coming in. This is going to be very significant. Why? Well, because the Fed's telling us this is important. If we now look a little bit closer here, this is the story that I think that if we close at the low of the week, again, big if, this data is likely going to be interpreted as bullish. Why? Non-farm payroll is going to come from 263 down to 200, which means less people are going to be getting jobs. Also, the unemployment rate is going to be ticking higher from 3.5 to 3.6. That could finally be some evidence that the Fed is finally getting what they want. A little bit more initial jobless claims as well. And we also saw that PCE number coming in line on Friday. Maybe the market's going to interpret that as being bullish. As we now focus on the Fed for this week, the Bank of Canada hiking by 50 instead of 75 have markets once again looking for a pivot or a blank. After a 75 hike next week, a 50 basis point hike is likely to follow. But if anything, we see hawkish risks as official will look to avoid a re-loosening of financial conditions. That's from Citigroup. So keep that note in mind. Let's read this next one here from Bank of America. 243 rate hikes thus far in 2022. The bond market is now pivoting from inflation to recession. Plus, BOE, RBA, and BOC policy blinks mean a Q4 bear hug risk asset rally. Whoop! That's what we just talked about. 10 weeks. That would take us all the way through to the end of the year, pretty much. But we say recession shock equals new highs for credit spreads and new lows for stocks come in the first quarter of 2023, which is pretty much what we just reviewed when we looked at that 2008 versus 2022 comparison. One more article here. Bank of Canada dials back pace of hikes amid recession fears. Blah, blah, blah. I want to read one article here. One quote comes down here right at the very bottom. Wednesday's smaller than expected rate hike comes amid increasing pitch political debate over monetary policy in North America. The clam is taking fire from both sides of the political spectrum in Canada. And the head of the U.S. Senate Banking Committee is calling on Chairman Powell to stay focused on employment as the Fed attempts to stabilize prices. What is that? It's called political pressure. The Fed is supposed to be independent. As of right now, there is definitely some pressure coming from almost every major bank. Americans should brace for a cash crunch in a painful recession, experts say. Jamie Dimon, David Solomon, and Ray Dalio warned this week. These guys are all smart, smarter than me. All right, now we're going to shift gears here to some of the other G7 countries. Bank of Japan conducts emergency bond buying to underpin debt market, but yields keep rising. What does that mean? They're losing control, but they're still trying to be out there and plunge protect. Versus what's going to happen starting on Tuesday, and that's going to be the BOE is going to start selling bonds on November 1st, but not long-dated gilts. So there are some issues that are brewing in these major central banks. And the reason why this is important is because when we now look here to history, I want you to think about what we just reviewed and ask yourself whether there is a chance we could get that bear hug rally all the way through to the end of the year, and then whether or not history is repeating itself. If you want to see this tweet, it is under my personal account, Justin Caron. I will link that in the description. This is from August 20th, and now we're going to provide an update on SPY, BTC, and ARK, because I believe these different risk assets really provide a good clue for the psychology of where we currently are. So if you look to where we were about 2 months ago at about 420, we were over here above our pink line, and we were looking for us to come back down. Where are we now? There we go. So we're looking here at a few areas. We're looking here to the blue area, which comes below the pink line, and then we snap back up, and then we come down to form a lower low. What is that here? That would be us over here in anxiety. Isn't that what the market's currently feeling? Why am I getting margin calls? The rally is taking longer than expected. I think so. I think that is very much in regards to where we are right now. So if it's been playing out perfectly so far, I want you to pay attention to the relative low before we got our big pump. So I'm talking about this basically small inverse head and shoulders area here. Why? Because that is the area where on our dead cat bounce, we should kind of top out. We should kind of be topping out right here. So if we're currently in this area, it means that we're actually due to go down. But I believe we're going to defer this next leg lower unless we actually project here this week. I think we're not. I think we're actually going to continue to march higher. So SPY right now is still showing us that there is a lot more downside to go through if we're ultimately going to repeat the psychology chart, let alone 2008. And I know a lot of people are saying that 2008 and 2022 are different. Yes, I understand that. There's different credit risks right now. But what's more important is the technicals, meaning technically speaking, is the chart giving us more evidence it is correct than not. Looking here to Bitcoin, this one's really interesting too, because when we look to the update now, roughly 2 months out, on Bitcoin, we were looking for we're below our green line. We should dead cat bounce back up to the red line. Yep. then we should keep rocking this red line lower, which is what we're expecting here. Now let's see an update. So we came in, we actually hit the red line, check. We came back down to the green line, check. So from green to red, back to green, back up to red. It looks like as of right now, we should continue our slide to form our last low. Our last low probably coming in here at about, I don't know, about 16,000. That's what I think. The way we would invalidate this pattern is by breaking above the 200 weekly moving average, which right now is at 23,794. So call it 25,000 just for the sake of a nice round number. So Bitcoin also telling us that it's really respecting this range here, is likely going to coil up for longer. And then we can start our next big boom, maybe 2023, but likely 2024. After we get out of anger, into depression, and when people start getting depressed, that's the time to buy. Yes, I know. That is a great euphemism. All right, ARK, last one here. If we look here to ARK, this one's also like textbook psychology here. Let's have a look. So we look here to ARK, where we form our penetration of the green line, which is roughly where we are here. And then what do we get? We got a lower low. That's right. So we get a bounce off the green line, then we form a lower low. And when we look here to our chart, there's the green line, there's the lower low. And what's really ironic is that Cathie Woods on October 10th published a letter to the Fed. She issues an open letter to the Fed saying it is risking an economic bust. What does that sound like? Let's read the psychology thing here. I don't know if we're currently in anger for ARK or if we're over here in depression. It kind of sounds like anger the more I think about it. Who shorted the market? Why did the government allow this to happen? Why did the government allow this to happen? Let's read this thing from Cathie Woods one more time. Cathie Wood issues open letter to the Fed or the government saying it is risking an economic bust. Boo-hoo, right? Sorry, Cathie, boo-hoo. And when I look here to the chart, this is likely where we are now. I think we're probably right here in anger, which would align with our psychology chart. So what does that mean? Well, we probably got another dead cat bounce here, which could take us to, I don't know, maybe as high as about 45. And that's because we're looking for up to 10 weeks on the S&P to go higher. All right, so now that we got all of that out of the way, let's look at some more charts here, because I think it's really important for us to keep in mind that we were looking for about 15%. So I mentioned this earlier, 15% in about 10 weeks. How much have we gotten so far? From our low, we're now up by about 12. So we go here, we're up by about 12 from peak to, from the low till the high, about 12. So if we go 12 divided by 15, it means we're about 80% of the way there. So if you're now only finally getting bullish, yep, you missed about 80% of the move. Does not mean you can't make some money here, but if you're only getting bullish now, that's like a little bit of a warning. And I think that there could be some false hope when people are looking here to the bear market area or -20, which is 384. And we've now officially closed a weekly back above that. This is also really important because when we look here to our 15-minute chart, I called this out to our private group. There's a link in the description if you want to find out more about that. There is this 15-minute candle, which once it closed above 384, that's where the squeeze started. It really started to go higher after that. And before, we had a head and shoulders pattern. So that head and shoulders was invalidated, and we went higher in a dramatic way. That is the squeeze. That is the bear hug. So if we know all of that, and we understand that for this week, what we're looking for is a higher high, but we're also looking for the low to hold. We're not really looking to go much lower than 374. That would be a lower low and a higher low and a higher high. If we now look to our daily chart, what does that mean? Well, it means that we're probably going to get a back test here to our 50 DMA, if not a little bit lower. Right now, we're at about 383 for that 50 DMA. Coming back down to 373 or even just 380 would be an area I would pay attention to. This is really where we had a lot of consolidation inside of June before we pushed higher, which I think we still need to do before we can advance. So I'm looking for roughly 390 and roughly 370, or about a 20-point range for us to consolidate, kind of like we did over here, where we consolidate for a little bit before deciding to go higher. So that's what I'm paying attention to now. Other than that, the next thing we just want to look at is going to be QQQ. So looking here to the Qs, we got QQQ. And what we noticed that we actually broke our downtrend. We closed 2 consecutive weeks over the 200 DMA, which means that there might be a trend change happening, because after 2 weeks, that usually signals the potential for a new trend. If we can poke above 285, we could keep going higher. I think it's more likely that we're going to dip back down to test the relative low and back test this 200 weekly moving average. If we look here to QQQ on the 1-day chart, we're also going to note that we have that inverse head and shoulders with the breakout. We have not yet claimed this 50 DMA. So there's going to likely be a push-pull around this area before ultimately claiming it. That's what I believe. Two more quick things we want to look at here are just going to be the things that would normally cause us to go down. Also want to note that Ethereum is up about 5% or about 25% versus this time last week. So when we look here to the dollar, there's also some warning signs that it could, again, keyword being could, be going lower. It could just be another base it forms before advancing. But I think after this week in the Fed, we're probably going to see some softness. Why? We now have three consecutive daily closes below the 50 DMA. Shout out to Cordell for mentioning that. So this appears like if we're going to be going down, the warning signs are here. Looking for potentially a retest to about 106.56, which is going to be our multi-decade high, going all the way back to 1989. There you go. Going to the VIX here. VIX is now repeating a lot of what we mentioned last week, where it's likely going to have a volatility drop. Let's go higher here. A volatility drop before ultimately rocking higher into Q1 of 2023. Finally, we got the 2-year note actually closing the week out red, which is good. Then we also have the 10-year note closing down here by about 5%. That is also good. So with that said, if you've enjoyed the video, I encourage you to smash a thumbs up, subscribe to the channel. If not, you can watch last weekend's video where we went through a lot of the playbook which got us here. I wish you all the best of luck this week, and I look forward to seeing you on the next video. Thanks so much.